Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be jumping around to a number of different markets, talking more short-term trading strategies and overall trends as we are chatting with Dana Lyons, fund manager and editor of the Lion Share Pro website. Now, Dana, broadly this week, and I guess you can even go back to last week for the broad averages, there's some momentum that has been lost. Now, that is after the Dow ran up to that 40,000 number. The S&P also hit all-time highs. The correction in the Dow has been fairly quick and almost straight down for the last almost 10 trading days. But broadly, there didn't seem to really be a standout sector this week because of the fact that everything, maybe at best, was flat. Most markets gave up a bit of their prices. Dana, you see anything out there that is telling you that there might be a bigger situation going on here with some of the momentum potentially shifting to the downside for a bit more than just a few days or a few weeks like we have seen over the last kind of year and a half?
Yeah, thanks, Corey. We don't see any major alarm bells going off right now. Like you mentioned, we did have that great rally, especially the first quarter up into the peak and new all-time highs in all the large cap averages and even some of the broad averages, and including the advanced decline line. So that was a really positive development. The fact that we've seen some consolidation since then shouldn't be overwhelmingly concerning. Our models did whiplash a little bit in April with the pullback, but it's back in positive ground right now and holding fairly firm. So we're not too concerned about it. We did see one area of concern was that this most recent leg of the pullback was led initially by the broader market, which we want to see as big opponents of breadth. The market itself or any individual stock is going to be guided by the direction of the overall market to the extent of about 70%. So what we want to see is good participation, and the fact that we saw the broad market lagging again in this early pullback in May or a couple weeks ago was a bit of a concern. I guess the encouraging sign is that at the end of this week, as we've seen the large caps really get hit, the Dow, the NASDAQ 100, S&P, the mega caps, the encouraging thing is that the broader market, which had, like I mentioned, been hit already, pulled back down to some pivot support levels, has really been resilient over the last couple of days. And actually, small caps, mid caps, even most of the equal weight averages were up yesterday and up again today, and breadth has been really solid the last 2 days, despite the sharp losses in the large cap averages. So the fact that the broad market has not fallen apart, even as we wrung out some of that large cap risk, is certainly a positive development here.
Well, Dana, just pulling on that string, it is interesting to see the small caps, the mid caps, and the larger market breadth not getting hit as bad as some of the large cap stocks, in particular the tech stocks. And the weighted averages, when you look at the indexes, they're so weighted to those mega cap stocks, whether it's the NASDAQ, the Dow, the S&P 500. Are you encouraged that in this kind of a scenario where the small guys and the mid caps actually lagged first, but then held their ground, that the big mega cap stocks, as they've corrected down now, that maybe it's just that was the smaller cap stocks were kind of front running the move and now they've held their ground? Could that mean that maybe the move in the mega cap tech stocks will also find some footing here, tracking the broad markets? Is that giving you a signal when you look at your quantitative analysis that maybe the markets are actually doing better than maybe some traders feel this Friday?
Yeah, I think there is a lot of validity to that. We saw, if you look just overall, if you zoom out a little bit, we're seeing still higher highs and higher lows in the mega caps and the large caps. So despite falling apart at the end of this week, they're still in good shape overall. And whereas we had that risk embedded in those large cap averages as they've held up very well up until the latter half of this week, there was certainly a lot of risk embedded. Like I said, a lot of risk embedded in those large cap averages. And my concern was that with the small caps in the broader market already pulling back and sitting on some important support levels. If we saw that risk manifest in large caps, with the small caps, with the broader market kind of lose support and fall out of bed, and we haven't seen that. We saw a lot of that large and mega cap risk getting wrung out of the market the last few days, and we saw good resilience in the small and broader markets holding support, hanging in there. And like I mentioned, breadth has been very good yesterday and today, despite the sharp losses in the large cap. So I think that's the best case scenario, wringing out some of that large cap risk or potential risk, even as that broader market has held support and not lost any ground. So wrung out some risk and not really on a broad market basis, we're not really worse off for it.
Okay. So overall, still very constructive on these markets. I want to switch to commodities a little bit, and I want to talk copper because copper's been on an interesting run. Beginning of April, copper was just under $4. It ran almost straight up through all of April, and then in the beginning of May, really got going up to a high of $5.20 a pound, and then almost immediately reversed and is the whole way back to about $4.60. So it was again, spike and a correction right back to some of the levels where it actually started May. Dana, how do you look at a chart like this where it had its momentum to the upside, but it's been a pretty sharp correction back down?
Yeah, it's been very sharp, but that's what happens when you have volatile moves or sharp moves to the upside. They're going to correct sharply. I think what you have to do is look at the amount of retracement that we've seen. And at this point, since, if you're looking at copper, the move since from February to the recent peaks, you only seen about a third of that retrace. So as bad as the damage looks over the last week or 10 days in the precious metals, it's really only retraced a fairly small portion of that. And A, it's not unusual to retrace that. And B, the fact that we haven't really collapsed the entire move, it keeps us constructive. That, in addition to the fact that we're still well above those breakout levels, those former highs, not only in copper, but silver and gold. So we have a foundation, a technical foundation below the market that should make it difficult to just immediately collapse and break right down to those former lows. So I don't expect that to happen. I expect this to be more of a durable breakout. So we're looking for opportunities to add further to precious metals into the pullback now. Like you mentioned, given the huge spike in precious metals, the implied volatility has been expanded. So you have to expect more of this volatility, even on pullbacks and retracements. So you have to be a little bit patient in picking your spots in which to add further exposure, which we're doing. But we did add a little bit more into our copper position yesterday, and we'll look to add more across the board: gold, silver, copper.
Well, Danny, when you think about the moves that gold, silver, copper have had, like you say, they spiked up. The volatility has increased a little bit because of that. But in a bull market, and when things do correct, sometimes the moves down are a lot more shallow than people were used to, let's say, in a bear market scenario. So what signals do you look for where you want to position and buy the dips? Is there any technical levels or moving averages or retracement levels that you look at positioning into these sectors when you do see a pullback in a relatively strong bull market?
Yeah, certainly. If you're in a stronger trend, obviously you tighten up, whether you're looking at moving averages or retracement levels. You can be a little bit more aggressive in buying the dip from a retracement standpoint. You might, using the Fibonacci, you might jump in a little bit more on that 23 retracement or 38 retracement. But you have to be careful after these big moves that we saw. Looking at copper went up about 50% almost. 5% pullback is really nothing relative to that. So it might seem like a big pullback on a day or 2 days, and you might be tempted to get super aggressive and piling in. But you have to remember, get a picture of what that retracement looks in the context of the previous move. So definitely in a strong market, you look to tighten up or shorten those moving averages or retracement levels where you're going to buy. But you have to remember that volatility has expanded. So there is a little bit further room from an absolute price perspective for it to pull back. But the other, we'll be looking, just to answer your question specifically, more at the 23 and the 38 retracements, as well as, like I mentioned before, we have those breakout areas, really explicit levels that we saw breakout moves transpire in all three of those metals that are clearly defined. So anything approaching those breakout levels, we'll start being more aggressive, certainly in adding allocations there.
Since you're mentioning volatility, let's look at silver, because it's been the last about 2 weeks that silver has just been so volatile. Price-wise, it hasn't really gone anywhere from that kind of breakout above 30 that we saw in mid-May, but we're seeing $1 plus moves almost on a daily basis here, up and down, trending sideways, but there is volatility there that can bring in traders that like that sort of volatility. There's a lot of investors out there that like volatility. What have you seen in the silver chart? Anything stand out to you with just how much more volatile this price has been?
Yeah, well, like you mentioned, volatility does equal opportunity as far as we're concerned. And I think if you're a day trader, a swing trader, obviously this is the kind of environment that you relish and really can really make a lot of hay. So that is, from that perspective, certainly this is attractive. But from a longer term perspective, you zoom out, like we have, again, you saw that big move in silver from March, April up into the recent peaks. And despite the sharp pullbacks or sharp daily losses, we've really only retraced maybe 23% of that kind of the post-April move. So from that perspective, it's good to see generally holding most of those gains, not immediately collapsing. So from that perspective, we do have this increased volatility environment, so you have to expect bigger moves. But in the context of how much we've retraced, that huge rally, it hasn't been that much. So that is certainly a bullish kind of a development from a technical perspective.
Well, Dana, just one more on silver, because a lot of people listening to this call probably are in silver or the silver stocks, and they're looking at this volatility. When you look at something like a longer term chart and you note that it's been since 2013 that silver has finally been able to break above the, let's say, $30.35 level. So it's been over a decade that it's taken silver to finally break 30 definitively and put in some actual traction on the chart. What does that mean for you on a longer term basis when you look at the move that silver has made? Because now everybody's looking at the $49 to $50 all-time high in their crosshairs. Do you see a lot of congestion or resistance levels between where we're at now and that level? Or are we at the concern that maybe we've topped out here in the short term and we're going to go back down? How are you looking at silver more medium to longer term?
Yeah, sure. Really, you've had, a decade's worth of resistance that really we've overcome. So what was resistance technically, should, or theoretically should, become support. So typically we see that in practice. So we can assume that former resistance will be support. So again, any pullback towards that breakout level should be bought aggressively. And in terms of resistance on the way up, we've cleared a ton of it. So that opens up the upside more quickly and really openly for big moves to the upside. It's not unhealthy that we're kind of consolidating or digesting that recent sharp move to the upside. And the more we do, the more of those gains that we do hold on to in the near term, the better we are set up for, even another leg higher and another leg higher. So I think the big move obviously was breaking to new decade highs or whatever, opening substantial more upside going forward. So I don't see a ton from a resistance standpoint going forward. I think we did hit, if I'm looking at the SLV, the silver ETF, for example, we did stop right at that 50% retracement from those highs in 2011. So from a shorter term or maybe intermediate term standpoint, a logical place to pause, but I think the action has been pretty good. It has seemed very volatile over the last couple weeks. But again, relative to the rally that we've seen, I think it's held up pretty well and paves the way for even higher prices.
Fair enough. Even the recent quick corrections have stopped kind of right at now what could be that new support, or at least that blue sky above for the silver price. We'll see where it goes from here. Dana, great chatting with you. Thanks for taking time with us. We'll stop it at just these commodities and the broad markets, where it sounds like you're not seeing very much trouble out there. However, natural pullbacks, you do need to watch where those go to, and they can offer another buying opportunity, which, in all fairness, all pullbacks recently have been good buying opportunities, especially in the markets. Dana, thank you as always for your time. Hope you have a great weekend. I will post a link to the Lyons Share Pro website below this interview.
All right. Thank you, guys.